Are we set?
There you go.
Okay, great. Well, thank you all very much for coming. This is now, I think, the fourth of our quarterly meetings. So we welcome you, any newcomers, and we welcome you again to all those who've been here in the past. I'm joined today by my colleague, Richard May, and we're going to have a conversation, and we would encourage you all to join us in this conversation while we're having it. We're not going to have a question and answer period at the end. We're going to hopefully engage you all to join us during the conversation. But I'll let Chrissy talk to us about the rules of the road before we get started.
Hi, everybody. I'm just going to share my screen real quickly. All right. Well, welcome to today's event. I'm just going to go over a couple of details before we get started. First thing we're going to talk about is just asking everyone that comes in to remain on mute while conversation is happening. Just to minimize any background noise that could just be really distracting while we're trying to communicate. Obviously, if you have a question, you're going to raise your hand, unmute yourself, ask your question. When you're done with that, please just go back to muting yourself, just so we can be courteous of everyone else that's attending. If you have a question, we're going to use the raise your hand feature, which I will show you how to use if you're connected via Zoom. When obviously it's the same thing, when you ask your question, I'll let them know that there's a question. I'll ask you to unmute yourself. When you're done, mute yourself. The way that if you're using the Zoom application, the way that you access the raise your hand feature is if you're looking at your Zoom screen here, there's a little reaction button at the bottom. If you click on that reaction button, there is a raise hand feature, and you can just click on that and your name will appear in my list with a hand next to it. When you're done, it's the same function to lower your hand out of the queue so that you're no longer there to ask a question. If you are calling in from a phone, you can dial *9, and that will put you on the queue to ask a question. On your phone, it'll tell you how to mute and unmute yourself. And then when you're finished, you can also dial *9 to lower your hand. And that is the basic instructions. I'm going to stop sharing my screen here and hand it back over to Peter.
Great. Richard?
Yeah, I will summarize before we start the 4 topics that we're hoping to address today. We think there are at least 4 very major transitions going on in the global economy and around the world today. And we're addressing 4 of them. We're hoping to limit the discussions to maybe 10 minutes each. But the four that we think are most important are the transition brought about by interest rate changes over the course of the last year. And we'll have some discussion on whether we expect them to go back near to where they were, or whether they're higher for longer, or what. And Peter and I are going to have a conversation about that. We then turn our attention to the transition to an AI universe. And obviously, there's been a lot of publicity about AI, artificial intelligence, and how it's going to affect not only our daily lives, but the future trajectory of the economy and our country. The third topic we're hoping to address is the green energy transition. I think everybody hoped it would happen quickly. It seems to be happening, but it's not happening at the pace that some people thought it would. So we're going to talk a little bit about that, what it means for both the green energy, renewable energy, and traditional energy sources. And the last, if we have time for it, is the transition from workplace to work from home and vice versa. There's been a lot of publicity about whether the American employee, or for that matter, the European employee, will ever get back into the office. And we have some thoughts on that and what it means both for real estate and for business. So on that, let me just start off by, if I can pose a question to Peter on this first topic, which is interest rates. Howard Marks, which is a very well-respected hedge fund manager, has said what we've seen in the last year is a return to normal levels of interest rates. And I think there's a lot of sentiment that thinks we're going to go back to some universe of lower rates. What are your thoughts on that, Peter? And what does it mean for the economy?
Well, I think Howard Marks is absolutely right. I'm of an age, if you will, where I can remember mortgages at 14%. And throughout most of economic history, people have been able to earn a rate of return, and in fact, a real rate of return on their savings. We just came through, when I say just, I mean over the last, say, decade, which was a very anomalous period of time where essentially savers didn't earn anything on their savings. And that was terrible for savers. It was great for borrowers. Unfortunately, there are many more savers out there in the world than there are borrowers. So it also enabled various asset classes to get priced at astronomical levels. And as a consequence, there were disruptions in the markets. I think Howard's absolutely correct. What do you think, Richard? Do you think Howard's correct that we're getting back to a normal time with people earning money?
It's funny, when I started doing tax returns in 1980, and in 1980, most of the taxpayers had most of their unearned income from interest, not from dividends. It wasn't an era where a lot of people owned stocks or mutual funds. Most people kept their assets in CDs and treasuries. And over the course of the last 40 years, we've transitioned from that interest-based earnings environment to one which is definitely featuring returns on dividends and stocks. And I think we're beginning a transition perhaps back, as long as rates stay where they are. I think this does have some implications as far as investment, the choices that people have today. I think they may go lower because the Fed's promised us that they will, but they're not going anywhere near where they were between 2009 and 2020.
I would agree with you. They're not going to go back to those anomalous low rates, but we think that they're going to go back down. And the Fed has already signaled that it could well be in 2024 that there are going to be 3 interest rate cuts of 25 basis points apiece, which would be a total of 75 basis points. As long as inflation continues to look like and is well on its way to a 2% level. And if inflation gets down to that level, then interest rates should follow it down. And that should continue on into next year. So we could have some more interest rate cuts next year. And as far as practical ramifications of that, having lower inflation, which would typically lead to lower interest rates, should lead to higher price earnings multiples, which should mean higher stock prices and also higher bond prices. So it should mean good things for both the stock market and the bond market if interest rates go down. And when you think about, okay, well, what sort of outside of broad categories make investments in bonds and stocks, specifically within the stock market, you'd want to make investments in companies which are pretty highly levered, i.e. they've got a lot of debt, and some of that debt could get refinanced over the next couple of years. So one thinks of utilities as being highly levered but very necessary entities. Typically got debt coming due every year, so they can refinance some of their debt at a lower interest rate and thus lower their operating expenses. Companies, other industrial companies, which are highly levered and able to refinance, REITs, real estate, those sorts of investments that would benefit from a lower interest rate environment.
Another point that has been made by one of the investment services that we subscribe to has described the current situation as being the end of the first wave of higher interest rates, with the clear implication that they expect a wave two or subsequent waves after that. In the 70s, we saw three sort of distinct waves of inflation, every bit a little bit higher than the previous peak. Do you see any chance of that happening in the 2020s, what happened in the 1970s?
I don't think so, because I think our economy and the world economy, they're very different economies than they used to be. There's much more international trade. There's a lot more fluidity as far as trade goes around the world. There are not so many rules and regulations which inhibit trade. And if the markets are free to operate, then they will very readily discover price. They will enable trade to occur. In the 70s, when OPEC basically put an embargo on their oil, we were not a big producer of oil in those days. We were largely an importer. Thus, we got hit by a supply shock, and there was no readily available alternative source for us to get our petroleum. It wasn't until afterwards, i.e., after price rose dramatically, that all of a sudden a new price umbrella was created, and the drillers in this country, in the United States, started using better technology because they could, because price enabled more R&D. They used better technology and enabled drillers in this country to go after petroleum reserves in a much higher cost horizon than it is in Saudi Arabia, where you stick a drill bit in the sand and 20 feet down you find oil, and so the production costs are very, very low. In this country, in North America, in the Western Hemisphere, you need a much higher oil price to be able to drill profitably. But because of all the rules and the regulations back in the 70s, trade did not flow so readily. Now, if we have a price spike in oil as an example, but in most any product, it enables, because the lack of, or not as many regulations as there used to be, it enables business people to go out and find new sources of supply. So I really don't think that the two periods are comparable. I do think that with all the free trade that we've had in this world, one of the big fights that the Fed certainly fought during that near decade of anomalous economic period when we had next to zero interest rates, they were fighting disinflation, if not deflation. And that's a much more difficult fight to fight. Our monetary system, in fact, the world's monetary system, can better fight inflation. We've had more experience with it. We basically know that, well, if inflation goes up, we've got to raise the price of money. But when we fight, when we're confronted with deflation, that gets everybody in a mindset, well, I'm going to delay my next purchase because it's always going to be cheaper. And so people sit on their hands. And so the Fed never wants to see that. And that's why interest rates got so low, and they were encouraging people to borrow as much money as they wanted and consume it, invest it, but use it. Don't let it sit in the bank. We're not paying you to let it sit in the bank. So I think they're two very different times.
I think the world would be very happy if you're correct.
Mhm.
And in a way, I was listening to a Mark Zandi podcast yesterday. Mark's the leading economist with Moody's Analytics, and he said the economy in 2023 was rip roaring, was a really good year, and it's continuing right into 2024. Is there any danger, do you think, of that sort of Goldilocks scenario causing the Fed to kind of hold off on any interest rate reductions that might return the rates back to a little bit more benign level?
Not as long as inflation keeps going down. If inflation keeps going down, then again, I think the Fed is going to be concerned about disinflation. If they just keep going down, remember, as we maintain interest rates at our current level and inflation keeps going down, real interest rates are going up. And that's what the Fed's very concerned about. So if real interest rates go up too high, i.e. the expense of money gets really very high, then the Fed is tightening, inadvertently, they're tightening. And so they're going to have to loosen the monetary strings.
Yeah.
So I would think that as long as inflation keeps going down, no matter how robust the economy is, if they see no signs of inflation, I don't see why they hold up interest rates.
Well, this is a transition question, but the Federal Reserve seemed to be a little slow to react the last time when inflation started rearing up. I'm wondering if they're going to be a little slow on the curve to reduce rates, probably even waiting too long to reduce rates, which begs the question, would it be better to turn over the Fed policy to artificial intelligence? So that's our next topic, is we're transitioning to artificial intelligence using the Fed as a prime example.
Well, that's a very neat transition to artificial intelligence. Certainly there's yes, they could well be more hesitant because they remember a great deal from the 70s when they released interest rates or let them go down a little bit too fast and inflation did spike up again. They don't want to relive that lesson because that was a painful lesson. With regard to artificial intelligence, it might be a good idea, Richard, on the Fed's part to turn part of the decision making over, because they can very quickly, the computers will incorporate in more recent experiences, and maybe those more recent experiences will outweigh the experience that everybody keeps talking about in the 70s with inflation and the Fed being a little bit too quick on the gun as far as lowering interest rates.
Well, Peter, the other day we discussed AI briefly, and I think we both agreed that while the process of job replacements is sort of a gradual process, there may be more immediate and consequential effects of AI, especially in certain industries. And we agreed that in the chemical engineer industry and the chemical engineering industry, in biotech industries like that, artificial intelligence may make a difference right away.
Oh, I agree. I think there's enormous possibilities when it comes around to AI and anything called research. Now, always, as I speak here, I speak in the terms of there are bad actors out there, and if bad actors want to do bad things with a powerful new technology like AI, they're going to do it. And they're going to do it at the beginning, they're going to do it in the middle, and they're going to do it at the end of whatever the lifespan is of a new technology, and this new technology AI. So with that as a caveat, I mean, I think there are huge possibilities with regard to this technology helping man think more quickly, organize facts and history more quickly, put it to greater utilization more efficiently, quickly weed out paths that they should not go down because it's going to lead to a dead end. Discovery, think about huge discoveries that might come along once in a generation. With the assistance of AI, those huge discoveries might come along once every 5 years now, simply because we have the capability of handling so much more information, much more quickly, much more efficiently, and much more effectively. So it really does open up not only the world of knowledge which has already been gathered and maybe hasn't been put in the right order to solve a particular problem, but to take that knowledge and project a little bit and think a little bit more about the future. Now, AI is not, as I understand it, is not geared towards, let's say, it's not mastered its predictive capabilities yet. We're still in the learning stages of it. So it's very good at going back and gathering up all sorts of knowledge from various sources. And depending upon how the question is asked, depends upon how the information is going to get ordered and reordered to perhaps solve a problem. But just within that capability, there is great opportunity for advancement, whether it be in engineering research, biomedical research, any sort of investigation. There should be great opportunity for AI to be helpful. And when you think of beneficiaries of this, one of the downsides of AI is that it's a real energy hog. It takes a tremendous amount of electrical energy to run. I don't know exactly what they call them, but I'm going to use the term an AI farm. So you build these buildings, you stuff the buildings full of servers, and then you let these things go. And they suck up a lot of electrical energy. So anybody that's going to generate electrical energy in the future, because there's going to be a real shortage of it, should be a beneficiary of the greater utilization of AI. Getting the energy to that particular facility. So transmission lines, our transmission lines in this country are woefully inadequate for all of the new electrical power needs that we have planned for the future, whether it be for EVs, electrical vehicles, or for AI, as an example. And then trying to think of some others. And then currently today, Microsoft just announced their earnings, and the CEO of Microsoft on the call, as we were, as our associate Jared mentioned, talked about how Microsoft today is embedding their AI in almost every phase of their product. So it's not just wishful thinking. It's not just, well, this is going to be coming down the road in the next month or so. This is happening right now with Microsoft and Microsoft products. Google is another growing factor in AI. So there is practical utilization today of AI, and there is a huge future in front of it.
Yeah, and I have to add that there's a dark side to some of this as well. We think about the surveillance economy, where it's much easier through face recognition and tracking people's movements, tracking their cell phones, tracking their web usage, to know more about us than we even know about ourselves or our spouses. You get the concept of deep fakes. They're talking about a fake of President Biden calling people in New Hampshire, telling them not to vote. There were fake videos of Taylor Swift doing this, that, or the other. So obviously, it puts a lot of the onus on the observer to try to figure out what's true and what's not true, or what's manufactured through AI and what's truly a true representation. So with every new technology comes some of those shadows. And there are lots of people always willing to lurk in the shadows and do us some harm. It's interesting.
Richard, on that score, let me ask you, so do you think that we need to, at the same time this technology is being developed, do you think we need to have enhanced regulation of that technology?
Yeah, I mean, I think so. And I think so do some of the leaders of the technology companies. I think they've been probably more outspoken than the average citizen as far as the need for control. So I think there's probably a future cabinet post. It's just like the Homeland Security. This is AI protection as even a full cabinet member post at some point, probably depending on what administration takes over in 24 and 28. But I would imagine it becomes more and more important. As another transition, Peter, you were talking about the incredible energy usage of AI. That takes us right to the green energy transmission. How are we going to produce all that electricity that's needed to power AI and to power all the conversion to e-vehicles and more efficient buildings, et cetera? Is the utility industry going to completely transition from natural gas and other fossil fuel sources to renewable, or is that a gradual process, just like the AI?
Oh, it's very much a gradual process, and I believe what has been so disappointing to so many people who are at the forefront of the green revolution, if you will, is that it is taking as much time as it is taking, and as it is going to take, because you don't take an embedded energy technology like the internal combustion engine and hydrocarbons, which have been integral to our society and our economies around the world for over a century, and just eliminate them overnight. No matter how much you might want that to happen, it's not going to happen. The hydrocarbon energy energy format, if you will, is going to be around for a lot more years. It's still the cheapest form of delivering energy to the user that there is in the world. There have been great advancements with regard to solar, with regard to wind, and with regard to hydro, and lest we forget nuclear. But they're still not as inexpensive with regard to delivering power to the user as hydrocarbons are, and the energy they pack in a very condensed space to deliver energy to, say, an internal combustion engine. So some statistics. So in 2014, now the dirtiest hydrocarbon there is in the world is coal. And that's the first one that everybody wanted to get rid of. And there have been great strides with regard to getting rid of coal. So in 2014, coal generated in the United States about 300 gigawatts of power. That's electrical power. Whereas natural gas generated about 420 gigawatts. According to the EIA, which is the Energy Information Agency, it's an agency of the US government, in 2022, coal still generates 200 gigawatts of power, and natural gas has gone up to 500 gigawatts of power. So we've certainly made progress, but we have not eliminated coal, the dirtiest of all the hydrocarbons, and that was the one that we thought the easiest. You know, it's all utility oriented, so we'll just get rid of that. Well, it's not as easy as you think. I'm sure you all have heard and read that while the wind and solar, they're intermittent. And so as a consequence, we live in a society which always wants power on. We want it on 365 days a year. We want it on 24 hours a day. And you can't do that with either solar or wind. Now, how could you accomplish that? Well, you've got a much better developed battery technology. And so far, while there have been strides in battery technology, we're nowhere near where we need to be to have battery technology combined with wind and solar be able to supplant natural gas and oil for most uses, and even still coal. So what the politicians have tried to do, and this is not unusual, they've done this periodically throughout history. Governments have tried to entice people to switch technologies by offering various sorts of subsidies. And they've done this for years now with solar and wind. And it's very interesting. You see subsidies put in place and you see people drive towards that new technology. And then as soon as the subsidies are taken back, well, then nobody uses it any longer. And they go to the cheaper, probably older technology. And you've seen this in this country with regard to EVs. EVs came out and they're always first adopters of the new technology. And the EVs came out and there was a band of people that, you know, rushed on off and started buying EVs because they had a rather generous subsidy attached to the EVs. And then as soon as the government started pulling back on the subsidy, sales of those EVs started to decline quite precipitously.
Peter, we have a question.
Okay,
We have a
go right
question.
ahead. No,
Mike
sure.
Rumor?
Oh, was that me you were recognizing? I
Yes.
guess? Yeah, no, I was wondering in the energy storage area, it seems there are other technologies that look very promising, like the iron flow technologies from the ESS Incorporated. And I was just wondering, it seems like there just isn't enough incentive for people to use these things. They seem to be kind of slow getting going.
I think that's true with most any new technology, Mike. You're right that right now with regard to EVs, there's the chicken and the egg. People are afraid to drive out on the highways with an EV because they're not sure there's going to be enough recharging stations. And are the recharging stations actually going to work? And are they, is your car going to be able to accept the recharging receptacle that's at that particular recharging spot? And so until a lot of this gets standardized, people are going to be reluctant to, you know, go too far and adopt this new technology.
Peter, case in point is Hertz just sold back a lot of their e-vehicles fleet, which selling them off because apparently people that are renting cars aren't renting electric vehicles. And I sort of put this into my own viewpoint. If I went to a Hertz counter and they gave me a choice between an EV or a gas-powered or a hybrid car, I would choose the gas-powered or hybrid car because I know how to work them. I'd feel like a duck out of water driving an EV around the streets of Toronto or something, not even knowing how to exactly charge, how to find a charging station, and then even if I found the one that worked, being able to figure out how to plug it into my car. So well, that's obviously a problem.
I'm sorry.
No, please go ahead, Mike.
That's not the area I was looking at. I was looking at the area of the use of long duration energy storage at the utility level, which is now quite feasible. You know, and the resistance even to going to that.
When you say long-term storage, what technology are you talking, Mike?
Iron flow technology.
Okay.
One of the companies involved with that is ESS Incorporated, and they have these large systems that are stationary systems that apparently are far more effective for long duration storage than our lithium ion things.
Okay, great. Well, I learned something new. Thank you. We'll take a look at that.
Mike, does that replace the copper in the batteries, or how does it work? Do you know?
I don't know the technology of it, but it's they deploy them in tractor trailer size units and multiple tractor trailer size units, and apparently they can maintain the energy levels for much longer than other technologies. Okay, thank you.
Well, that's very interesting. Thank you.
Peter, I have another question in the chat.
Okay.
It says, what are the chances that the government will institute a permanent subsidy for alternate energy systems as has driven the petroleum industry?
Afraid I probably can't answer that question. I think it depends upon the administration that's in power at the time, and I don't know.
Let me offer some thoughts on where a lot of this transition is going to be funded. It can't be funded through commercial use only. It has to be funded either by the government or by what's happening in Canada right now. Private capital seems to be funding a lot of the decarbonization and some of the renewable energy products. Brookfield Renewable, which Peter, I know we have a stake in Brookfield, has been monumental in trying to gather capital in Canada and really throughout the world for projects in the Americas. And they've got a lot of solar, geothermal, hydro, all sorts of alternative power sources that they're deploying, not publicly traded capital, but private capital from wealthy families and institutional investors. So I read Brookfield's webpage yesterday, and in 2023 there was $1.2 trillion raised in North America for investment in renewable, and they're expecting 1.7 trillion in 2024. These are gigantic numbers, and then really what's needed is almost 3 times what's being invested this year. That would be $5 trillion a year going into, and I think you're talking about that kind of numbers that can't possibly be funded except by government or really private capital sources.
Sure. Yeah. And that's what it's going to take, and it's going to take a longer period of time than most people expect, but most transitions do. I think that's the point that we're really trying to make, that transitions take a long period of time because most people are reluctant to be first movers. They want to see it work. They want to see it be easy. They want to see it sort of drop in and replace what they're used to. So it takes some time, and people have got to be incented. But as Richard said, there are, you think of companies that will be beneficiaries of this move. And certainly right now, LNG companies, because that's the hydrocarbon. Natural gas is, if you will, considered to be the cleanest of all the hydrocarbons. So you get away from coal and you go to natural gas. Well, historically, natural gas has only been able to be moved through pipelines. So, but you couldn't used to move it internationally because there are no pipelines that went across the Atlantic or the Pacific. but they have enhanced the technology with regard to freezing natural gas and converting it into a liquid and then shipping it in specific types of tankers. And now it can go all over the world because there are enough of these tankers that have been developed over the last 10 to 15 years. And then when you get to the other side, if you will, you regasify, you turn that natural gas liquid back into a gas, put it into a pipe, and then that goes and feeds whatever entity needs the power. So liquefied natural gas is going to be a beneficiary of this. A company like NextEra Energy is going to be a benefit. They're already the biggest as far as biggest in renewable energy in this country. And I actually believe in the world. They've made the biggest investments in solar and wind power, in addition to having nuclear stations. So probably considered to be the cleanest of all the major utilities. Richard mentioned Brookfield Renewable Partners. Then you've got things like Chesapeake Energy, which is a natural, all they do is drill for natural gas. So those are some examples of some beneficiaries, both on the green side and on the hydrocarbon side.
And the United States is a beneficiary of the boom in liquefied natural gas too, because we've become truly a energy powerhouse because of natural gas.
Yes, we are now the largest exporter of liquefied natural gas in the world. We just usurped that position from Qatar. And how long that's going to last, I don't know that anybody knows, but there are plans on the books for, I think it's another 5 plants to be built. They're already a building, and they're supposed to come on stream this year and next year.
So that will allow everybody to work from home, right? So that's my next transition is, how about this? Nobody's coming back to work. Everybody's staying and working in their pajamas in their spare bedroom. Is that a permanent change?
Well, I think it's, well, if you talk to a younger generation, absolutely. They definitely want that. They don't want any more of the commutation or the commuting, if you will. And certainly when coming out of the pandemic, when labor was very tight, and labor was very tight because people were very reluctant to get around one another, and to just rehire people to restaff restaurants and ticket counters and all that sort of stuff. It was a huge chore, as I'm sure everybody on this call is very well aware. And employers had to pay a lot of money to get people back to work. There are obviously some occupations where you don't have to be in an office. And in fact, some might argue you might be more productive being at home than you would be in the office. Certainly, you save time that you would spend commuting. So that time is saved and banked. And a lot of the younger set would argue that it's a much higher quality of life as compared to getting into Center City, dealing with parking, all the commuting, the cost of it all, the risk of getting your car banged up, et cetera, et cetera, et cetera. But on the other side of the coin, and I think this position is espoused most heartily by Jamie Dimon of J.P. Morgan, and that is an organization loses its some of its core esprit de corps, its the camaraderie. You miss the idle talk or the happenstance talk walking down a hallway with a problem in your head and you run into a particular colleague and you start discussing the problem and serendipity occurs and you solve the problem. That gets lost. There also have been studies recently where corporate culture, as I was saying, although inartfully at front, gets lost. And the reason humans tend to be social creatures, according to a lot of sociologic studies, and they like being with other people. And so that corporate culture that successful companies work so hard, work over decades to build, can get lost as people go to their own silos. And that leads to inefficiency, people being ineffective, not working as well as a team.
And career jeopardy too, right, Peter?
Oh, absolutely. Yeah. Unfortunately, it's human nature, out of sight, out of mind. And I think it was Indeed that recently did a study that's a big hiring source, that over the last couple of years, as they go out and do surveys, they have noted that people who do not show up at the office at all are the most handicapped with regard to getting promotions and raises. Those who come in periodically are sort of fitting in the middle, and those who are there 5 days a week are the ones who get noticed by the boss, are the ones who are included in those, hallway discussions, are the ones who get included in closed door meetings, are the ones who get promoted, are the ones who have a much better career path now. And I don't think that that should really surprise a lot of people, because even when people were always in the office, there were certain people that, stayed late, came early, really got to know their superiors, formed relationships. Those were the ones that basically were on the proverbial fast track. And as Jamie Dimon says, if you want to work at JP Morgan today, and you got to be a hustler. And if you're a hustler, you're in the office 5 days a week. If you're not going to be in the office, you're not going to get promoted. So he sort of laid down the law, as have others in the world of finance. And it's a growing number in other fields. In fact, in technology, I think it's Mark Benioff at Sales Corp, sales dot whatever it is .com. He has said that people have got to come back to the office. So when we were fresh out of the pandemic, and it looked like employees, if you will, had something of the upper hand, employers had to acknowledge reality and say, well, the only way I'm going to get people to work is if we allow people to work not only in the office, but out of the office. And that is slowly but surely. Employers, I dare say, most employers would love to have that transition more immediately than employees would. Employees are sort of begrudgingly sort of coming back. And another worry for employees, and I heard this from somebody recently, and I absolutely agree with it. And that is, well, if you want to do your job remotely, but remotely is maybe 25 miles away from headquarters, but you are remote. You never come into the office, and your home is 25 miles away. You just say, I'm not coming in the office. I don't want to commute. Okay, fine. But that probably makes it easier for your employer to outsource that job to somebody in Bangladesh who might be able to do the job as well as you do, but do it for a lot less money. So that's a bit of a worry for employees.
There's a new thing that I think the name of it is called coffee stamping. and it's people that arrive at the office around 11:15 in the morning. They go walk around with their cup of coffee and see as many of their coworkers as possible, take one of them to lunch, comes back, puts the coffee down on the table, and then leaves for home. So he or she's perceived as working, but not really working, and probably not working at home either.
Interesting. I've not heard that one.
I wonder how they're faring in the promotion and raise bit.
Well,
Well, we did. Yeah, exactly.
depending
We
on
did
who
get
you're
through our four. We did get through our 4 topics. So do we want to open to any open questions? If
Sure.
any that people might have been holding till the end of the discussion? While we're waiting, Peter, do you have any thoughts about what happens to office real estate if this trend back to workplace doesn't recover back to the 2019 standards? Does that a whole slew of corporate office buildings that just go to the bulldozer, or what happens?
Well, yes, I think so. So, coming out of any real estate downturn, this has historically been true. The B buildings don't do well.
As in Class B?
You've got an excess in supply of any type of real estate. And so as the owners of Class A real estate are trying to fill their space, they offer all sorts of deals. And who wouldn't want to be a tenant in a Class A building versus a Class C building? So obviously, if you're a tenant looking for new space, and Class A buildings have now cut rental rates by 30%, and now you can afford that as a rental rate, you're going to go to the Class A building. So the Class C buildings, as coming out of any real estate recession, and we certainly had a real estate recession because of COVID. Those buildings, a lot of them are going to get raised, and that's even true for B buildings, Class B buildings. B buildings are either going to get raised or they're going to get repurposed. And Class A buildings, Class A office buildings, and I'm talking now about office buildings, A, B, or C. It's going to be much more expensive for the owners of those buildings to operate, because they're probably going to have to upgrade a whole bunch of amenities to make it fun to go to the office, to put up with the commute. Not only is your employer within the confines of your office going to have to make it more interesting to be at the office, maybe more snacks and more fruit and more, maybe there's a ping pong table or something like that. But the office building itself is going to have to add amenities like a delicatessen if it doesn't have one, so people can eat in the office building. An exercise center if it doesn't have one. If it has one, an upgraded exercise center. Maybe a sauna thrown in. Maybe offering so-called common areas, common space for tenants' usage at particular times at no charge or de minimis charge. They're going to have to make the place much more interesting, much more fun for people to come to. Now, there's going to be some space that's just not going to work, even A space. And those spaces, the landlords will no doubt try very hard to repurpose them, to transform office space into lab space, as an example, where you can get a much higher rental rate. And lab space is, if you look at most labs, the same sort of space that you would outfit for an office. In certain buildings, you can repurpose office to residential, but a problem in too many office buildings is that the way the floor plates are laid out they're typically very deep, and that means you have a core in the center of the building, which gets very little light. And depending upon how apartments are laid out, might not get any light at all. And so as a consequence, they become very unattractive living spaces. I mean, it's like, imagine you're going on a cruise. At least in the old days, they used to have interior cabins. So there was no porthole you could look at, no window but you paid a lot lower price for it. So you'd have this interior cabin, if you will, for your residents. And for a lot of people, they need to have light. That would be unsatisfactory. So long story short, as typical coming out of any real estate recession, lower quality buildings, they're going to get raised, or they're going to get repurposed. Higher quality buildings will get repurposed. I wouldn't expect too many of them to get torn down because they're too new, but certainly the owner is going to put forward any sort of effort he can to sort of rejuvenate the building and make it something different. Maybe make it more mixed use as opposed to nothing but office. Maybe it's residential office, it's lab and office. It's going to be something, and they're going to have to make the building more interesting for employees to go to work. So ping pong tables, tennis courts, squash courts, exercise venues, saunas, whatever it's going to be, operating expenses are going to go up.
I just want to remind everybody, if you have a question and you want to raise your hand, you can use that reactions button at the bottom of your screen or top of your screen, depending on how you're joined. And there's a raise hand function in there, or you can enter a question into the chat. I am paying attention to that, and I'll gladly read it for you.
No other questions?
No other questions?
Wait. I was going to ask either of our two speakers, what, if anything, should we be worried about as investors?
I'll let you handle that, Richard.
Oh, thanks, Peter. Neville, I'm worrying all the time. And there's always stuff to be, I mean, on the most peaceful day in the universe, there's always plenty of stuff to worry about. I think the investment community kind of assumes there'll be an end to the war between the Russians and the Ukrainians. The Middle East is a little more daunting because it doesn't seem like an easy solution. And I was reading, I think just in the last couple of days, that the North Koreans have been on war footing and increasing their war footing ever since the Donald Trump summit meeting in Vietnam ended with no progress. And they've been ratcheting up both their military and their nuclear program with the kind of assumption that eventually they have to do war with the South. So, I think some sort of a war in Asia or a lingering war in the Middle East, I think are the two biggest worries. On a longer term basis, and this is something Peter mentioned, Jamie Dimon earlier in the talk. He said yesterday that the United States financially is heading at a cliff at 60 miles an hour. And right now there's nothing to slow down the financial disaster that's awaiting us. I mean, we've been waiting for the disaster that's the US budget deficit for 30 years, and it hasn't derailed the economy yet. But I have to think at some point there's a tipping point. Peter?
I would echo your concerns and add that recently we've had a couple of treasury auctions which haven't gone well. Now, the market got unnerved that particular day, but then seemed to slough it off afterwards. But you know, if these are sort of early tremors, to sit there and say, well, not everybody in the world wants to own a U.S. Treasury.
Yeah, considering that the Chinese used to lap up a lot of those treasuries, and they're not buying any these days.
Yeah.
And the Saudis are only buying selectively. So we have to find some new buyers to walk into their shoes for ever increasing supply of treasury notes, bills, and notes. Thank you, though, Neville, for the question.
I'm not sure I feel like thanking you for the answer, but thank you.
All right. Well, we thank you very much. Richard, I thoroughly enjoyed our conversation today.
I did too.
And we look forward to seeing you all again at the end of the first quarter, when sometime in April, we'll have another one of these conversations.
And perhaps with a surprise guest as well.
Okay.
Thank you. Very interesting.
Thank you for coming.
Thanks a lot.
Thank you.